So hello everybody, my name is Jan Brustein. I'm the venture analyst. Today I'm doing something a little different. I'm breaking down a company I just had, in my view, the most significant week in its entire corporate history, and most people haven't put it all together yet. This company is Volatus Aerospace, ticker FLT on the TSX Venture Exchange. I want to be upfront from the start. It's an independent research. I'm not paid by this company. I have no position when I wrote for this company, and nothing I say is investment advice. So you do your own due diligence. Okay, let's start. So here's the setup. Volatus Aerospace, its ticker is TSX, and the TSX.V is FLT, Canadian Aerospace and Defense Company. My rating is a speculative buy. 12-month target is $1.4. This is CAD. Current price around 0.68, so that's roughly 106% upside. And speculative, the word speculative, this is telling you this is not a safe, boring dividend stock. This is a company that's very active in a very active growth phase in a sector that's generally at an inflection point with a list of catalysts that are stacking up pretty fast. So let me show you why I'm interested in this company. Okay, so 5 things that happened in the last 10 days. When I was laying them out, I realized the market still hasn't priced all of this in. The stock's sitting 30% below its 52-week high despite all of this happening. So let me walk you through each one. February 17th, Canada Defense Industrial Strategy drops. This is a big deal. The government commits $6.6 billion under a $81.8 billion defense reinvestment plan. An explicit name in the actual policy document, unscrewed and autonomous systems as a sovereign priority. This is Volatus's core business. They did not pivot to this theme, and they were already there. Then February 18th, Volatus is named to the 2026 TSX Venture 50. This is the annual ranking of the top 50 performers on the TSX.V. They rank 16th overall, top 3 in technology, and 280% share price appreciation in 2025, along with a 441% market cap growth. That's not a minor accolade, that's an institutional recognition. February 23rd, they appointed Krish, I'm not going to say the last name, I'm going to butcher it, as a chief technology officer. This guy led over 40 million pounds in EU-funded defense, euros, my bad, and AI programs. He has a deep expertise in counter-drone systems, autonomous platforms, and long-endurance surveillance. So this is not a PR hire. This is someone that you hire when you actually want to build things at a scale. And then yesterday, February 26th, Volatus receives conditional approval to graduate from the TSX Venture Exchange to the Toronto Stock Exchange main board. It's a very big one. I'm going to spend a whole slide on this in a minute, but just understand this changes who can buy this stock completely. So 5 catalysts, 10 days, and the stock is still 0.68 cents. That's the setup. Okay, let's talk about the company and their financials. Let me make sure everyone understands what this company actually does, because the name Volatus Aerospace might not mean much to you if you're not in the space. They're Canada's most vertically integrated dual aerial platform. What does this mean? It means they operate both crewed and uncrewed aircrafts, drones essentially, for commercial and defense customers. They do this across Canada, US, UK, and Norway. They usually work for the government. So 4 pillars to the business: aerial intelligence, the ISR operations, that's intelligence, surveillance, reconnaissance, UAS manufacturing at their Mirabel facility in Quebec, which is actually ramping up right now, advanced autonomy and counter-drone capabilities, and training mission support services. Their customers are oil and gas companies, utilities, and increasingly NATO partners and the Canadian Armed Forces. Now the financials, because this is the venture analyst, we look at the numbers, Quarter 3, 2025, we had 10.6 million in revenue. That's up 60% year over year. That's a record quarter for them. Gross margin held at 33%, which is impressive because the equipment sales jumped 427% this quarter from defense demand, and equipment carries lower margin than services. So they grew fast without destroying their margin profile. Adjusted EBITDA was at a loss, minus 660,000, but that's a 52% improvement from the same quarter last year. So on the right trajectory, though a loss. Management has said break even happens somewhere between $13 and 13 and 14 million in quarterly revenue. They just did 10.6 at 60% year-over-year growth. The math on that, on when they get there at that 13 to 14 million in a quarterly revenue place, is looking pretty good for 2026. I think it's going to happen this year. For cash position, they hold approximately $40 million in pro forma after November 2025 financing events. That's a real runway. So let's talk about the defense macro. I want to spend a minute on the defense macro because I think this is genuinely important for the context, not just for the hype. The 81.8 billion, that's Canada's total commitment to reinvesting in the Canadian Armed Forces. Within that, 6.6 billion is specifically targeted at the Defense Industrial Strategy, which is a framework for building domestic capability. And the framework built partner by explicitly says that Canada will prioritize building things domestically first, partner second, by internationally last. That is a structural shift in how Canadian defense procurement works now. Now let's look at the 6 capability domains that have named as sovereign priorities, and let me tell you how many of these Volatus exact business. So unscrewed and autonomous systems, that's their core. Aerospace platforms, yes. Digital systems and sensors, yes. Training and simulation, yes. They have a whole training division. Arctic and northern operations, yes. They inherited Arctic delivery infrastructure from Drone Delivery Canada. And then lastly, we have AI-enabled capability. Yes, also. They just hired a CTO specifically to accelerate this. Every single one, Volatus didn't build itself to fit the strategy. The strategy was written to describe what they already have built. This is a very strong possible position to currently be in. Okay, now let's discuss the TSX graduation. Yesterday's breaking news. So February 26, 2026, this press conference went out. Volatus Aerospace has received conditional approval to graduate from the TSX Venture Exchange to the Toronto Stock Exchange main board. I won't explain why this matters so much because I don't think the average retail investor fully understands the structural implications. When a company trades on the TSX.V, the Venture Exchange, a huge percentage of institutional investors cannot buy it. Like, they actually cannot buy it. Not because they don't want to, but because their mandates exclude it. ETFs, pension funds, large institutional portfolios, their compliance documents say TSX listed equities only. The TSX.V isn't TSX, so they're out. The second Volatus moves to the TSX main board, the entire pool of capital becomes eligible buyers for the first time. That's not a small thing. The second effect is the analyst coverage. Brokerage research desks, TD, BMO, Concard, National Bank almost never initiate on TSX.V listed names. TSX graduation is what triggers formal initiation, and each initiation brings its own wave of institutional discovery and you buying. Now, important caveat, and I want to be precise here. This is a conditional approval. The company still needs to satisfy the customary TSX listing requirement. They haven't given a day yet. Shares continue trading on the FLT during transition, and they've also said they'll seek shareholder approval at the next AGM to authorize the board to implement a share consolidation, though they explicitly stated there's no immediate plans to do so. So I'm watching for the final due date announcement. That's going to be a significant catalyst for when this comes. Now let's move on to the technical analysis. So let's look at the price action because the chart tells an interesting story, although we don't have the chart pulled up. Okay, so try to pull up the chart. I'm not able to show you guys, but okay, so let's look at the price action because the chart actually tells an interesting story. A year ago, March 2025, FLT was trading at 13 cents. That was the low. From there, the stock ran essentially continuously through the rest of 25. By December, hit 97 cents. Then it pulled back, came down to 68 cents, which is where it is right now. The pullback in the context of everything I just described looks like consolidation phase, not a trend reversal. So here are the levels I'm watching. Support zone is 55 cents to 62 cents. That has been tested multiple times. It's holding below 52 cents will concern me. That's where I'll revisit my thesis. Current price 68 cents is inside a rational entry window. My entry zone is 60 cents to 72 cents. Ideal is closer to 62 cents, 65 cents if you can get on a weekday. The first resistance is 97 cents. The 52-week high, that's the first technical target. And then my 12-month target is $1.40. That's my base case. And then there's what I'll call the re-rating scenario. If the TSX graduation triggers institutional coverage, initiations, and the stock starts getting discovered by completely new pool of buyers, $2 or more is not crazy. But I'm not putting that as my base case because it's an option. Okay, let's move on to valuation and price targets. So I want to show you exactly how I get to $1.40 because I don't just throw targets out there. I show the work. I'm using a forward revenue multiple methodology, which is appropriate for this company at this stage. They're not yet profitable, so earning multiples don't apply, but they have real growing revenue, so we can compare them to similar companies. So the methodology is 9-month revenue was 26.9 million, up 32%, with Q4 consensus expected to be above 11 million. The annualized run rate is approximately 40 million heading into 2026. So we have the bear case is 42 million expected for 2026 revenue at a 2.5 times multiple. That gives you about 45 cents per share. The growth slows significantly and no large defense contract lands. We have the base case, which is 15 million at 3.5 multiple. That's 88 cents. This is execution on the current trajectory with a DIS contract in the second half of the year. And then we have my venture analyst bull target, 70 million revenue for 2026 at a multiple of 4.5x. That gives $1.4. This requires TSX graduation, a DS contract win, and a continued NATO expansion. None of these are certainties, but all three are actively in motion. Let's get the re-rating scenario. If Volatus gets compared to U.S. defense tech comps like AeroVironment, which trades at a 5 to 7 times revenue as a profitable drone company, Shield AI at a 10 to 15 multiple as a pure autonomy play, the multiple case gets much stronger. At 6 to 8 times multiple of revenue, that's $2 plus. Now let's look at peer comparison on the next slide. The TSX.V listing is suppressing the comparable multiple. That discount closes when the listing changes. There is the value gap I talk about. So let's move on. Okay, so here we have the catalyst roadmap. Here's the full calendar of what I'm watching over the next 12 months. I track these obsessively. Now we have the TSX conditional approval already covered, final date coming. That's a near-term event I'm focused on. Q1 2026, Q4 25 earnings. Consensus is around 11 to 13 million in revenue. Be particular, any sign of EBITDA is approaching break even would be significant. Watch the equipment versus services mix. We have Q1 to Q2. We have the Mirabel manufacturing launch, production, assembly, and integration starting in Quebec. This is the moment Volatus transitions from being a service company that operates aircraft to being a manufacturer that builds them. That's a different valuation conversation. We have the H1 2026 first DIS contract award. This is the biggest potential catalyst. A build partner buy begins procurement. Volatus, one of the very few Canadian companies with the regulatory approvals, deployed infrastructure, and NATO relationships. They're generally well positioned here. In the first half of 2026, we have TSX final listing. This formal graduation, which is what triggers institutional coverage wave. And then through 2026, we have the EBITDA break even at 13 to 14 million quarterly revenue. They flip profitable at current growth rates. That could happen Q2 or Q3 2026. That changed the narrative completely from money-losing startup to profitable defense company. So up next, we have the risks and honest register. I never skip the risk section. If you're going to trust my analysis, you need to know where I'm not hiding anything. The biggest risk is not yet profitable. 40 million of cash buys meaningful runaway, but it's not infinite. If growth stalls, the loss widens, you need to be able to stomach that possibility. 470 million shares outstanding. That's a massive share count. Even at 68 cents, that's 347 million market cap. That share consolidation that's now at the table could change the per share math significantly, depending how the ratio they choose. Watch AGM materials carefully. Revenue lumpiness, Q3 60% growth was largely driven by huge jump in equipment sales from defense demand. Equipment sales are lumpy, one quarter without a big equipment order, and the headline number looks like a miss. Even if the underlying business is fine, don't overreact to a single quarter. Another thing is the DIS contract timing. Policy is not contracts. Canadian defense procurement is notoriously slow. A DIS win could be 12 to 14 months away from being signed as a purchase order, even after being announced. Manage your timeline, and I'm not hiding any of these risks. They're real. Position size accordingly. So let's get to my verdict. So speculative buy at $1.4 target, entry zone 60 cents to 72 cents. Here's my honest thinking on this. You almost never see a setup where a company has 5 major catalysts in a single week, genuine fundamental catalysts, no press release fluff, and the stock is still sitting 30% below 52-week high. That's the setup right now with FLT. The TSX graduation is structural unlock I've been looking for in a company like this. When the final listing date is announced, the buyer universe expands overnight, and that rating is not priced in at 68 cents. The defense macro is not speculative. Canada committed $81.8 billion. They named the exact capabilities Volatus provides as sovereign priorities. That's procurement byline, not a rumor. And the entry zone, 60 cents, 72, inside a rational risk reward window. Stop consideration is 52 cents. If I can get in around 65 cents with a stop at 52 cents and a target of $1.40, that's better than a 5-to-1 risk reward ratio. I'll take that. And this is speculative. I'm going to say that one more time. This company is not yet profitable, has 670 million shares outstanding. Defense contracts take time. This can go wrong. Position accordingly. But the setup, the timing, the catalyst stack, and the valuation gap relative to where the company could trade 12 months from now is compelling enough that I wanted to bring this to your attention today. So I'm Jonathan Brustein, the venture analyst. If you found this useful, check out my full written report in the description. I go much deeper on every number. I sat here with all the sources. Nothing in this video is investment advice. Do your own due diligence, and I'll see you in the next one.